Let me now bring on board Jonathan Garner, Chief Asian and Emerging Market Strategist at Morgan Stanley, who joins us from Hong Kong. Jonathan, good morning. Thank you for joining us. Jonathan, what do you make of the earnings season so far in Asia? Disappointing, surprising, or on expected lines?
Well, for Asia, excluding Japan, it's just about as expected, but we've only got about 10% of companies reported thus far, so it's still very early days, but there's a modest earnings miss, about 1%, and that's much better than we saw for most of last year, so we're cautiously optimistic that we're at the beginnings of an earnings upswing. For Japan, where there have been substantial upward revisions to earnings estimates, we've had a modest earnings beat, about a 2% earnings beat. More companies have reported there, about 25% of market cap, and that's a beat for the recently finished financial year.
Why has the risk-reward equation started to deteriorate for Japanese equities, which have been doing really well? Year-to-date, the market is up.
Well, we've got to within about 10% of our TOPIX target, and that target is 1270. And in valuations, we've re-rated from below 0.9 times historic price to book to about 1.3 times. So perhaps more importantly than that, if we look at the relative valuations to developed equities, we're back to 10-year average valuation multiples. So having strongly preferred Japan within global equities for most of this year, indeed from late last year, we've recently become more tactically cautious.
Jonathan, you also track the global liquidity picture with the magnifying glass. Of late, Japan has been a net recipient of global liquidity. Do you think in the near term Japan will continue to be a net recipient, or it's a matter of time global liquidity will start once again moving out of Japan?
What we've seen, if you look at global equity funds, is about $25 billion of fund inflows to Japan equity product since this all got going early in the fourth quarter last year. That is the largest period of fund inflows we've seen to Japan equities by global investors since 2005-06, and it's approaching the total quantum that we saw in 2006, albeit that relative to funds under management, it's smaller.
What's the view in China? It's out with its PMI data later this week. How's China looking to you at this point?
Well, we are overweight China as well as Japan and Australia. I think in China, other than an earnings pickup, what we're really looking at is significant valuation support. If you look at the forward PE for MSCI China, it's still bumping along the bottom around the 90th percentile of cheapness to history. We saw the market do very well in the fourth quarter when it looked like there was a growth pickup. More recently, we've had a sell-off on the somewhat disappointing growth numbers that we've had, particularly for Q1. But through the remainder of this year, we expect that growth situation to improve. And the official PMI will be an important signpost in that regard. But it's not the only thing that we're looking at. We're constantly monitoring the rebalancing of the economy towards consumption-led growth, which we think is well underway here.
Jonathan, you've recently trimmed your MSCI emerging market target. What are your views on Asian equities now?
Well, for MSCI EM, our target's 1220. We prefer emerging Asia and actually prefer Asia ex-Japan to global EM. So we have high teens upsides essentially on a scenario-weighted basis to our target prices for Asia ex-Japan, somewhat less for global EM. And when we look at the story that we have here, it's one where valuations have moved back well below long-run average levels. But we expect mid-teens earnings growth for this year, particularly with some of the cyclical sectors, energy, materials, industrials, particularly industrials, consumer discretionary, doing somewhat better this year than they did last year. And then continued strength in earnings growth from the financial sector, which is the largest sector in EM and Asia ex-Japan.
Right. Doesn't recent commodity correction make net commodity importers like India more attractive to you?
Yes, again, we've had a correction. In some areas, we think that's overdone. In areas like oil in particular, we expect $100 Brent to be the average for this year. And we're also seeing some reasonable stability in key non-traded commodities like iron ore. It does, though, the weakness that we've seen in commodity prices help some of the importers, and it certainly caused attention to focus somewhat on India over the last, let's say, 10 days to 2 weeks.
Jonathan, weakness in commodities also address some macro issues ailing India. It impacts positively current account deficit. Inflation has started showing signs of moderating. more headroom with central bank to cut rates. Are these enough to turn positive on India, or would you rather wait for growth momentum to pick up?
Well, India ranks number 10 out of 25 countries in our quantitative model, so it's not quite an overweight, but certainly it's one where we're incrementally positive. We'd expect it to fully participate in that mid to high teens upside I mentioned in our regional equity targets. And I think when you actually look at valuations for India, they are in line with the rest of EM versus its own long-run history. There are other markets that are significantly cheaper to their own long-run history than they have been on average, like China, for example. But in India's case, the key to the market really is sustaining a growth pickup whilst controlling inflation. So we're watching WPI inflation particularly to make sure that stays below 6%. That's tended to be associated with good performance from the Indian equity market.
Jonathan, what do you make of the earnings season so far for Indian companies, and do you read upgrades or downgrades based on the earning report so far?
Well, it's again broadly in line with expectations. There's no particularly strong story there. I mean, what we're seeing is markets like ASEAN beating and a market like Korea somewhat missing, but India's broadly meeting with expectations right now.
You recently turned positive on the real estate sector. Would you advise investors to add cyclicals to their portfolios or stick to defensives?
Well, at a regional level, we've been overweight real estate for some considerable time, and that was a key part of our call last year, particularly on China real estate. I think you might be referring to our specific views within the Indian market, and there, yes, we've increased our cyclicals weightings quite considerably recently. My colleague Ridham Desai is overweight the cyclicals, including real estate, consumer discretionary, materials, industrials, and he's underweight the defensive areas like healthcare and staples, and actually also telecoms.
What is your view on Indian financial sector per se?
Well, with a growth pickup and hopefully sustained inflation and hopefully a relatively low trajectory for yields, that's the kind of environment that's good for financials. In particular, if the rupee is reasonably stable, which is our call at the moment. So, yes, we would like financials.
Right. Your Indian strategist believes a case for Indian equities is very strong. Do you share the optimism? What could be the possible risks? And the primary one at that.
Yes, we do share that optimism, albeit that there are other markets that we are more bullish on in the region, mainly because of a greater degree of undervaluation. But there's about 20% upside to his Sensex target, which is about 23,000 here. And that's something that we'd certainly concur with at the regional level.
Jonathan, appreciate your time and glad you could accommodate this interview request.